Next up, we have Cindy Parker, our Vice President of Operations in Northern California, that's going to introduce our next speaker, Mark Priven. Cindy.
Thank you, Daryl. Good afternoon. Everybody, carbs are starting to wear off a little bit now. Mark will bring you all back, I can promise you that. So, Mark Priven serves as Director, Regulatory and Alternative Risk Consulting at Bickmore, and has 15 years of experience serving public and private agencies and pools. Previously, he worked as vice president at one of the largest international brokerage firms and supported retail brokerage clients. During his career, he also served as a senior reserving analyst and lead actuary for a large California insurance company. Mark is a frequent speaker at industry conferences such as RIMS, Institutional Investor, PARMA, and CAJAPA. He serves on the California Workers' Compensation Insurance Rating Bureau Actuarial Committee and the Associate Member Council of the International Association of Industrial Accident Boards and Commissions. He was selected by Workers' Comp Executive as one of the most influential people in workers' compensation in 2010 and is a fellow of the Casualty Actuarial Society. Mark has written and co-authored several articles, such as Claims Liabilities and Liability Reporting, which appeared in the fall issue of the IAIA-BC Journal. He holds a Bachelor of Arts degree in Philosophy and Mathematics from the University of Pennsylvania. Mark will share with us his insights on the estimated costs and savings expected from SB 863, what employers should expect in the short term, mid-term, and long term, and how to have that challenging conversation with your financial colleagues about realistic expectations about the impact of SB 863. Ladies and gentlemen, Mr. Mark Priven.
Hello, everybody. Can you guys hear me all right? All right. Hello. I know you guys might be a little tired this afternoon, but I am completely psyched because I heard my 5 favorite words today, and I didn't know they were my 5 favorite words until today. More time for the actuary. All right. I mean, I gotta say, I like Sedgwick. I always like Sedgwick. I do a lot of actuarial studies. I love it when Sedgwick is the TPA because I know the claims are gonna be well handled. It makes my job a lot easier. But you guys are over the top today. More time for the actuary. Mi casa es tu casa. Before I get into the reforms, I just want to note one thing that's very important to me. I'm rebranding a little bit today. You'll notice on the slide it says Ask Geeky, G-I-K-I. Okay, this is a shout out to Siri. I'm trying to rebrand a little bit. I want to be sort of the Siri of the insurance world. Okay, so you know, actuarial geeky. I know it's going to take a long time to catch on, but you know, I'm hoping it does. One of the things though that I know Siri already has me beat on. Is that, you know, when I do actuarial studies, oftentimes I'll go and I'll explain it to the client and I'll go through the methods. And you know, afterwards they'll say, you know, Mark, you do a good job explaining it. And while you're talking, you know, I understand what you're saying, but let's face it, tomorrow it's just going to be a big black box to me. Siri is a black box. I mean, how can I compete with that? The other area that I think Siri has me beat in is, you know, again, with the actuarial studies, a lot of times I'm presenting information, and for some reason, clients don't often like to hear that their costs are going up. So I have, on occasion, been accused of being a little heartless. Now, I just want to point out that is completely a rumor. However, with Siri, again, it's actually clinically true. Siri is heartless, and it's not just a medical condition. So, for example, if you say to Siri, you know, take me to the airport, and she takes you to the zoo, you know, she doesn't apologize, right? She doesn't send you flowers. She'll say, oh, here's a free month of cell service or anything, right? She is heartless. So, you know, Siri is my guide, but I know that she's out ahead of me quite a bit. So I'm looking at Jan. I realize you probably didn't ask me to be here just to talk about Siri. So let's get into California workers' compensation. Let's see how this clicker works. There we go. Okay, So first I'm going to talk a little bit about the background on California workers' compensation leading up to the reforms. I'm going to fill in some of the numbers that people have talked about earlier in the day. So first of all, the total rates, and Martin and Jason alluded to this earlier this morning, the total rates for California workers' compensation are quite high in compared to those of other states. Currently, I think about third. Again, this is prior to the reforms. Secondly, medical costs have been inflating at an extremely high rate and comprise a disproportionate portion of the total compared to other states. Loss adjustment expense also is a disproportionate percentage of the total. And lastly, the PD benefits are actually quite low in comparison to other states. So I'm going to go through and fill in some numbers here. Again, here, this is similar to what Jason and Martin showed earlier. California is one of the highest cost states in the country. And if you look at the premium, and they showed this, but I want to make a slightly different point. You can see that this is the total premium by year in the California workers' comp industry. And you can see there's a huge spike prior to the prior series of reforms, SB 899 and 227, 228, and so forth. That huge spike, well, what I hear a lot is that these reforms were necessary because everything that was in the prior reforms has now been eroded and that we needed these new reforms. I just want to point out that I think they got out in front of it a little bit this time, that the premiums are quite high in the most recent years, but they're nowhere near the spike that they were prior to the prior reform, like in 2002, 2003, prior to the other reforms. So they didn't wait until the reforms had completely eroded. They actually got out ahead of it a little bit this time. So I just want to sort of correct something that I keep hearing a lot in the industry. Again, this is just premium, but you can also look at losses and see the same thing. It's a little bit less extreme, but this shows the ultimate losses by year, by accident year, in the California workers' comp insured system. And again, you can see that prior to the 2004-2005 reforms, the ultimate loss was higher, much higher, than it is in 2011. So for example, in 2002, it was $12.6 billion a year. And in 2011, it was 9.1. So that's still 20–30% lower in 2011 than it was prior to the other reforms. So I just want to point out, again, I think they got out ahead of it this time. They didn't wait until the entire thing had unraveled. A little comment here about the pie, where all of the costs are going. And again, Jason and Martin had talked about this too. A disproportionate amount to medical, a disproportionate amount to expenses, and not nearly as much to indemnity. Okay, this shows what's happening with the medical expenses. They've been increasing quite a bit over the last, say, decade or so. The question is, why are medical expenses going up? So if you look at a sort of CPI-type index, what CPI does is it takes the same basket of goods, and it says, how much does that basket of goods cost at one period versus another period? So here we have medical costs. California Workers' Comp specific, this is done by WCRI, which is a great organization. What did that one basket of goods cost in 2002? It cost $100. How much would that same basket of goods cost in, I think it's 2010 or 2011? $105. Very little inflation, only a 5% increase. Okay, so what that tells you is the inflation that's happening in the medical industry or in workers' compensation is not that the cost for the same goods of services is going up, it's the actual utilization that's going up. So people who have the same injury now are going to the doctor more. Every time they go to the doctor, they get more treatments, and so forth. So it's really a utilization problem. It's not that the same services are costing that much more now than they used to. Okay, and this slide shows the rate at which medical payments are made. And this is a really big problem with California workers' compensation from an actuarial or geeky perspective, and also I think from the injured worker. California medical costs pay out much, much slower than other states. So what this shows is For each one of the solid lines, like the bottom solid line on the left is what % of the payments are made in the year of the injury. Of all the medical payments, what % are made in the year of injury, and as you go to the right, then the year after injury, and then all the way on the right after that. And the solid lines are the different percentiles of the different states. So the blue line is the lowest state. The next line up is the 20th percentile state. So 20th percentile state means 10 out of the 50 states pay slower than that. And what you can see from that dotted line there is that California is below the lowest of any of the other states in terms of what % of medical is paid in the first year, in the year of injury. They are also at the lowest of all the states in what is paid in the second year of injury. And of course, they're the highest of all the states in what's paid after that. So from a projection standpoint, that makes it very difficult, but also from an injured worker perspective, they are getting their medical treatment much slower than in other states. So it's really a lose-lose situation. I think this was a big part. This was also something that the reforms tried to address, as we heard earlier, resolving the claims earlier, getting people their medical treatment faster. Okay, some of the other areas that have been increasing quickly. This is medical cost containment. Okay, the blue line shows medical cost containment per claim as of 12 months. And the red line shows it above that as of 24 months. They are increasing at 23 and 24% annually. 23 and 24% annually. That is not a sustainable thing. So again, that is another thing, another indicator that folks were looking at when they were looking at what to do with the reforms that they were looking at trying to correct. This shows allocated loss adjustment expense, so primarily legal fees, also inflating at a very high annual rate, and litigation rates. So, and these slides, by the way, you don't have to like write a lot of stuff down. I mean, I think they're all going to be available through Sedgwick at the end. And I purposely put up a lot of graphs, some of which I'll spend a lot of time on, some of which I won't. But I wanted to provide a lot of information so that when you ask Sedgwick for a copy of the slides, you'll have that information and you can use it for your own presentations or your own analysis or whatever. So I realize it's a lot of information, but I purposely wanted it so that you would have it as on your record, when you get the slides from Sedgwick. So what this shows is that the litigation rates also have been going up, both in Northern California and in Southern California. No surprise, it's a little bit lower, a little less litigation in Northern California, but has been increasing. And this slide shows the loss adjustment expense, California in comparison to other states. So on the left-hand side are the low-cost states, and as you move to the right, it's in percentiles. You go to the high-cost states, and you can see that the red line at the top is California, of course, one of the highest cost states in terms of loss adjustment expense. And again, this is something that motivated the reforms. This is something that people who were looking at the reforms were saying, we need to cut out some of the administrative costs so that we can have room to increase PD benefits for injured workers. And this is the last one that compares California to the other states, and this is regarding specifically the PD benefits per claim. And this is the one that I think labor was the most upset about, and I think a lot of people, including insurance companies and employers, recognized was really a problem. Each of the lines, again, not the dotted line, but the other lines, are the percentiles of the different states. So you can see the bottom line there, not the dotted one, but the solid one, is the 20 percentile. What that means that 10% of the states had PD benefits below that. The blue line, 40% of the states had PD benefits below that. And you can see that California, that dotted line, it was between the 0 and 20 percentile in terms of the states that was least generous in terms of PD benefits for folks who had a PD claim. Okay, so we were, 20 percentile is 10 states, so we were roughly about in the bottom 5 of all the states in terms of how generous our PD benefits were, in spite of the fact that our workers' comp system was one of the most expensive states in the country. So that was really the imbalance. Again, I'm just trying to show you numerically what people have been talking about the imbalance that's in the or that was in the California system that the reforms tried to address. Okay. Okay, now let's talk about the reform. So we've spent a lot of time this morning going through all the different provisions of the reform, so I'm not going to repeat them here. Getting back to the SERI thing, I would like to think that SERI would have had a hard time with the reforms too. I mean, the actuaries, the geekies, we had a hard time pricing reforms. I would like to think that SERI would have had a hard time too. One of the areas, in addition to pricing reforms, that I think we have on SERI is, frankly, personality. I mean, SERI can fit her entire personality in this, I don't know, 2 by 4 inch little black box here. As far as actuaries go, we don't need nearly such a lavish amount of space to fit our personalities in here. I know a lot of experts out there who know actuaries and talk to them might have disagreements about what sort of container you would need to fit an actual personality in it, but it's usually in terms of pellets or something like that. Nothing nearly so large. Okay. This slide shows the details. These are the projections from the Workers' Comp Rating Bureau. And this shows the details for each one of the provisions that was in the reform bill, how much the savings are projected to be. Okay, and I'm gonna lay out the Workers' Comp Rating Bureau because they're sort of the scorers of record, I guess, on this issue. But this is what the Rating Bureau actuaries determined to be the savings. And I'm not going to read them off. You can see them. But you can see at the bottom there, it shows a savings of, what is that, 5.3%? Or 6.3%, sorry. Does that mean that savings will be 6.3% as an employer? Does that mean that you're going to see savings of 6.3% from last year to next year? Absolutely not. That 6.3 does not mean that's the savings. That's the overall savings you're going to get. Without any reforms, let's pretend the reforms never happened. The Rating Bureau projected that costs would go up by about 15%. Okay? So now you add on to that the projected impact of the reforms of a minus 6.3%, and you get like a 9 or a 10% increase. Okay, so I know there's a lot of talk about the reforms saving money, and I do believe that they will be a savings, both in 2013 and beyond, but that does not mean that when you net that against sort of the backdrop of inflationary cost, of inflation that's been happening in the workers' comp system, that there's an expectation, certainly by any of the actuaries, that there is going to be a net overall savings. Yes, the reforms, in my opinion, yes, the reforms will result in savings, but again, it's against a backdrop of a 10 to 15% increase, annual increase that's happening anyway. Does that make sense to everybody? Okay. Another thing I just want to point out is that this number is only for the insurance portion. So the $120 million on the return to work stuff is excluded from this. Okay, so there's an additional assessment that people are going to have to pay that's going to be on top of this. So this full 6.3% is not going to necessarily be realized. Some of it's going to be offset by an assessment. I have my own independent projections, and I'll say the net of what I think and what the Rating Bureau actuaries have come up with is pretty similar. I'm a little more optimistic about the reforms. I'm a little more pessimistic about the background annual inflation without the reforms. So I still net out to 10-ish%, but it's because I think there's going to be more inflation excluding the reforms, but then a bigger impact of the reforms. Excuse me. There are some other projections out there. I don't know if any of you have seen them. They've been covered in the press. There's one by Aon, which projects that the reform will actually cost money, that it will not result in savings at all. And basically, if you go down the list of all the issues raised on this slide, Aon takes issue with almost all of them. Ogilvy will not result in any savings, that increase in the PD benefits will actually result in higher cost than was projected by the Rating Bureau, IMR, liens, all of that. They're basically taking issue with all that and saying that all the projections are too rosy. I also just want to mention on the Rating Bureau, these numbers are from the actuarial committee. Okay, this is their best guess as to how these reforms will be scored. When it went to the governing committee, and we have someone, Karen, here from the governing committee, when it went to the governing committee, they went in a different direction, and they recognized that when the last set of reforms happened, SB 899 and so forth, the actuaries and the insurance companies were generally very slow to react to the savings, and they generally underestimated what the savings would be. And they said, you know, we don't want to go there again, and we don't want to be slow to react to savings. And so what we're going to do is we're going to assume that the rates that are currently in place are okay, and we're not going to recommend an increase over the rates that are currently filed by insurance companies. So they actually, if you think about it implicitly, they implicitly assumed that the reforms were going to be actually more effective than what's in here. But I think the reasoning was that they realized that the projections in the past have been too, and I'll say conservative, in the sense that they weren't reacting fast enough to what was going on, and so they decided to get out in front of this and make a little bit more, I guess, bold assumption on the reform. So you'll see different numbers coming out of the Rating Bureau, one from the actuaries, one from the governing committee, but that was their reasoning. There's going to be the Department of Insurance. My understanding, as of this morning, is that there's going to be a rate hearing with the Department of Insurance on Friday, and they are going to take this matter up, and then they will make a recommendation as to what they think is going to happen on the reforms. And so there will be yet another set of numbers to deal with. But right now we have mine, we have Aon's, and we have the Rating Bureau. If any of you, I've written up a whole, a whole 10-page or 15-page point-by-point thing of what I think is going to happen with the reforms. If anybody wants a copy of that, let Sedgwick know and I can get you the link. The Rating Bureau information is all online on their website. All their filing information is here. This is just taken from their most recent filing. So if you want to see, all the details of why they think what they think, I encourage you to go on their website. If you have a hard time finding it, let me know and I'll send you the link directly. But it's good information. Okay. Okay, as has been pointed out several times today, the reforms are being phased in, specifically the PD benefit, or I guess most importantly, or in terms of dollar-wise, the PD benefits are being phased in, so they increased somewhat in 2013. The last slide showed the net impact of 2013. This slide shows what the net impact is after the 2014 increases occur, and you can see that it takes another bite out of the proposed savings or calculated savings. In addition to what I just talked about, there are several areas of the reforms that could not be quantified because I want to say it's because they're still in regulation and so we don't know how it's going to turn out, but the truth is we did estimate savings for a lot of things that are still in regulation. So for example, we did put a number on IMR, IBR, even though that's not quite out yet. But there are other ones like the med legal changes, like RBRVS, like interpreter regulations and so forth, that we just don't have a sense of how they're going to turn out. And so we just couldn't put a number on it. I didn't put a number on it, Rating Bureau didn't put a number on it. So there's a lot of things that are just still not quantified even in any of the analyses that you'll see. The Rating Bureau is going to be doing an annual cost monitoring report, just like they did with the prior reform. So again, you can just go on their website once a year, and they will go through each of their projections and score it as to what the most recent data says. And so that should be really interesting to see as things unfold real time what happens. Last time they did it for about 4 years in a row. They did it through 2008 or 2009. And so they did it for a long enough period where you could really see what was going on and what was coming to fruition and what wasn't. And hopefully they'll do the same thing again this time. They've committed to at least doing a few. Okay, so this slide, basically what we do, what this is just sort of walking through the permanent disability process. First you have your impairment, your whole person impairment and so forth, then any adjustments, then you have the PD award, which is affected by the min, the max, the number of weeks and so forth, and then any final adjustments. This slide, I've highlighted in blue all the things that were affected by the reforms. This is probably a little hard for you all to see, so okay. But it's the things that we've been talking about this morning, the FEC adjustment, the min, max, and so forth. Okay, to give you a sense of where the dollars are really going, the increase in the min and the max was the big deal. It was really all about the max, okay? The max was so low that many, many employees hit the max, and so many, many are affected by raising the max. There were not that many on a percentage basis that were hitting the min that are affected by increasing the min. So it's really, you know, when I was modeling it and saying, you know, if you change this much, it changes that, it does this, that, it was all about the max, okay? And because of that, these reforms will affect different industries differently. If you have low-paid employees versus moderately versus highly paid or whatever, they may be affected by the max differently than what we're assuming for the general population for California. So all of our projections, the rating bureaus and mine, are based on sort of an average California wage distribution. If your industry or your company is low wage or high wage or whatever, your results will vary. And it'd be a very good thing, I think, to ask your actuary or ask your management, whatever, to try to figure out how you may deviate from the California average in order to figure out whether these PD increases, particularly the max, is going to have more of an impact on you or less of an impact on you. The other piece on this slide is the add-ons, and you can see here that really psych was the big driver. The sex add-on was not that, I know, gets a lot of giggles, right? But it really didn't have that much of an impact on the overall results. It was really the psych. And again, there were some last-minute changes to the psych in terms of whether it's really going to be implemented on a catastrophic claim and so forth. What does catastrophe mean? But that was really the one that had the biggest impact. Okay, bump up, bump down. We actually had data that shows exactly for PD claims what percent were bumped up, what percent were bumped down, and what percent had no bump whatsoever. And so the blue lines on the left-hand side for each of these time periods, the highest bars were actually no bump up or bump down. That was by far the most common outcome for a PD claim. The next one down was, of course, the bump up, which happened about 3 times more than a bump down. And that's why eliminating it resulted in savings. Again, I think this is going to be very different for different employers. I think particularly large employers probably are better at return to work, have more of an opportunity to provide return to work for their employees, and so it's possible that they didn't have as many bump ups as the general population did, okay? And as a result, eliminating the bump up, bump down may not have the same impact for a large employer as it does for, say, a mid-size employer, okay? So again, if you want to think about, you can take the statewide reform estimates and what you want to try to figure out how they apply to you, it might be interesting if you can to look at your own statistics. How much bump up versus bump down did you personally have, did your company have, and how would you adjust, the impact of the reform to reflect that you're different than the statewide average? Okay, liens, a lot of talk about liens. This graph actually shows the liens that were filed with the state. It shows the history. And The really interesting thing you can see sort of on the left is sort of builds up, and then there's this huge spike, okay? And then in January 2004, there's a huge drop-off, okay? That huge spike, that huge drop-off is January 2004 when there was a $100 filing fee instituted. So Christine mentioned that there was a huge drop-off, it was measurable and so forth. So there was a huge drop-off, 40 to 60% of, or half the claims or something went away, or the liens went away. It stayed like that for a while, and then you can see there's a period, so there's like there's four distinct periods. One is the lead up, the second is when the filing fee is in place, then the third, you can see an immediate jump up, right? That's when the filing fee went away. So it's like a perfect experiment. Filing fee goes in, liens go down. Filing fee goes away, liens go back up. I mean, what could be clearer? And so this is exactly how we derived our estimates of how a filing fee would impact the number of liens that would be in the system. And then the last little bit there, you can see a big drop-off. That's the implementation of EAMS. So that also caused a big drop-off in the number of liens. The other thing I'll just add here is that first buildup, you can see there's a huge spike right before the filing fee goes into place in January 2004. That is, because of that, hopefully we learned from that, that people will file all their liens right before the filing fee takes into place. And that's why they have that $100 I don't know, it's application fee or reinstatement fee, I forget exactly what the term is. They were trying to get away from having that kind of spike again. So that's why they put in that $100 application fee. I think that's the right term. And so it'll be interesting to see when we look at this graph, 6 months from now or so, or something, whether they were successful in doing that. This pie graph shows the distribution of the age of liens, and this is the age from the date of service to the lien. And you can see about half the liens are 0 to 1 year, and then a whole bunch are 1 to 2 years, and then a whole bunch are 3 or more. So roughly 1/3 of the liens have a lag of 2 or more years. Okay, so this is relevant because the new, once it's fully implemented, nothing over 18 months, right? The quote statute of limitations is going to be 18 months. Well, you can see just doing 2 years would have gotten rid of 1/3 of the claims, or 1/3 of the liens. So it had a very big impact on our analysis of the liens. The fact that they put in that 18 months. I know that's being eased in, but once it's finally in. Okay. This is about IMR, and I have to say IMR is by far the hardest one of the provisions that we estimated, because it's never been done in California for workers' compensation. We don't know, if the regulations haven't been written, so it's really very subjective, and yet it was a huge deal to employers. People felt like it was going to potentially have a very big impact on costs, and so we couldn't in good conscience ignore it. And so what we did is we looked at Texas, because the IMR provisions that are going to be in place in California are hopefully, or at least intended, in my understanding, to be fairly similar to those that are in Texas. And so in 2001, Texas implemented IMR, or they passed IMR. I think it implemented in 2002. And unfortunately, from an analytic standpoint, they implemented a whole bunch of things at the same time. They implemented some treatment guidelines and some things regarding spinal surgery and so forth. So it wasn't just IMR by itself. And of course, we know that Texas is not California, and so things are different. But what we did see, and I'll show a few slides of what the Texas experience was after implementing IMR, were some very substantial changes in both medical costs, in temporary disability costs, in dispute resolution in general. And so that is part of my basis for being optimistic that it could have a similar impact in California. So this green line here, we have some bars here, but the green line shows what they call temporary income benefits, what I think we would call TD, temporary disability. And you can see that sort of dip there after the implementation of IMR. That's about a 15% decrease, okay? If we had anything near a 15% decrease in TD costs in California, that would be a huge deal, and that would far outweigh any increases in PD that have been contemplated in this reform. So I'm not suggesting TD will go down by 15% in California, but I am suggesting it could be a substantial amount. Some of the other bars show, for example, the pink bars at the top there, those are return to work. So those show that after the implementation of that reform, they had better return to work. And as Christine said earlier, that's really the goal. That's the win-win situation for employers and employees is fast return to work. And the other, I'm sorry, the top bars, that was the blue bars. The top bars, the pink bars, are the speed of medical treatment. So you can see that the medical treatment happened faster. As I described earlier, it's a big problem in California how slow our medical treatment is. So I'm just very excited when I look at what happened in Texas and I see, lower TD costs, faster medical treatment, better return to work, all coming after instituting IMR. Again, they implemented other things as well, but IMR was one of them. This graph shows medical costs, and again, about a 15% decrease in the 2 years after IMR, and some other things were implemented. Again, if we saw anything close to a 15% decrease in medical in California, that would be huge. I mean, medical is about 2/3 of the total cost. A 15% decrease would be astounding. Again, I'm not suggesting that costs are going to go down by 15%, but I am suggesting that there is potential here because of IMR to have some very substantial savings. This shows the speed that medical, again, we're still on Texas IMR. This shows the speed at which medical payments were made. And basically, the higher you are, the slower the payment is. And you can see that prior to the reforms, or just after the reforms, all those lines come down. What that represents is that claims, the medical is getting paid faster and faster. Again, one of the goals of the reforms in California. This shows the decrease in medical disputes after the reforms. So before we were just talking about temporary disability and medical costs and so forth, but you can actually see the number of disputes going down with IMR in Texas. And here you can see the number of services that were denied. And this shows kind of a pattern that I think we would expect to see. Initially, this was prior to reform. The first few bars are prior to the reform. There's a certain level of denials. And then it spikes up when IMR comes in and things get tightened up. And then it kind of drifts back down as people adjust what medical treatment they get, and they adjust their expectations based on how they know IMR is working. So again, to me, this is very strong evidence, and this is very specific to IMR, it's denials. It's very specific evidence that IMR can really have an impact. Again, recognizing Texas is not the same as California. So, now we're on to strengthening MPNs. Again, a very big deal for employers and something that they wanted in the negotiations. What we did is we looked at claims that were initially in MPNs, that they were part of either an employer or an insurance company that had an MPN, but eventually went outside of the MPN. And what we found is substantially higher medical costs, temporary disability cost, and permanent disability cost once they left the MPN. And so the way that we scored this is we actually looked at what would happen if they were to have to stay in the MPN. These increases essentially wouldn't be there. So we had to make an assumption as to what % of claims would not be able to go outside the network because of the reforms, but we were able to actually look at empirically what the extra cost of going outside the MPN is, and scored on that basis. And again, it's quite comprehensive. It's PD, it's TD, and it's medical. Okay, it's sort of a holistic change. Okay. I want to get back to the pie chart that shows, sort of where all the costs are in California to make this one point. If you think about what costs inflate quickly, it's medical and an expense, right? I showed that medical was going up quite high every year, that the cost containment expenses are going up 23, 24% a year, okay? Those inflate at a very rapid annual rate. The indemnity increases at a much more moderate rate. And what this reform does, one of the things that it does, is it shifts money from the parts of the pie that inflate quickly and puts it into the parts of the pie that inflate more slowly. And so aside from just what are the one-year savings or what are the two-year savings, I think it will change the rate at which the whole pie grows, because now you have the part of the pie that grows more slowly bigger, and you have the part of the pie that grows more quickly is a little bit smaller. So I estimate this by itself is about 0.5% to 1%. It knocks off about 0.5% to 1% of annual inflation in medical costs just by changing the distribution of costs within California. Okay? And one last thing is the impact that this will have on liabilities. So far, all we've talked about is going forward. What is this going to do to my rates, my funding, my new PD claims, and so forth? It was alluded to earlier this morning, but I just want to highlight some of these provisions take effect on all claims, okay? Even those with dates of injury prior to January 1st, 2013. And to generalize, those provisions that impact the claims prior to January 2013 are provisions which will save you money, okay? The ones that cost you money, like the PD increases, only take effect on claims occurring or injuries occurring after January 2013. So aside from what it's doing to the rates, it can only be good news for your liabilities, okay? There's nothing or almost nothing substantial in this reform that will cause your liabilities for injuries occurring prior to 2013 to go up. There is the possibility, and there are some provisions that could decrease the cost of injuries which occurred prior to 2013. I'm thinking specifically about liens and specifically about IMR, okay? So again, for you all as managing your self-insured book or your insurance book, keep in mind that there's the rate and then there's also what's happening with your liabilities. I think this can only be good news for your liabilities. This was unlike 899, which went back retroactively in terms of the re-rating PD claims. If it wasn't permanent stationary, they got re-rated, or they got rated under the new system. That's not the case here. It has to be an injury after 2013. Okay. Okay, so where are we? Again, just to recap, is going to be a transition year, as 2013 is a transition year. I believe there will be net savings in 2013 and in 2014. Some of the things that will be different for individual employers based on your wage levels, the min and max will affect you differently. Based on if you're in Northern or Southern California, the lien provisions will affect you differently. And based on your size, the elimination of the bump up, bump down will be different. And again, I think this overall package should decrease the rate at which the entire pie of workers' comp costs inflate over time. And I believe that's it. Any questions?
Thank you. This is very entertaining. I have a question related to...
Thanks, Siri.
Yes. No, really, it was quite good. I'm looking forward to seeing the slides. In reading through actuarial reports, because I don't have a life, I had a question about how you think you might be handling projections. I mean, if we're going to be going to actuarial reviews for self-insurance plans, for annual reports, as opposed to,
right,
the current structure. How do you think you might be handling two things? One is the effect of SB 863, and the other question I have related to SIP and actuarial has to do with how the handling of IBNR might be addressed. Because typically, as a claims administrator, we're not reserving for IBNR.
Right.
And so I'm wondering, in an actuarial looking at providing reports to SIP, how you might account for both the new legislation as well as how you might look at IBNR in those situations.
I'll try to answer, and let me know if I don't hit the mark on answering your question. In terms of what's get reported to the SIP, that obviously is not determined yet. They're still figuring out exactly how it's going to work. My guess is that the TPA will not be required to report IBNR or the actuarial numbers. I think there's going to be a different report that the actuary or the employer will have to report, but that will not be on the TPA to do. That's just my sense. I don't have great inside knowledge or anything like that, but I just wouldn't expect that to be on the TPA to do. Is that one of your questions?
Actually, it was. It is in the sense of do you expect that you as an actuary will be addressing IBNR as part of the SIP report, even though we don't reserve for IBNR?
Yes. So
there's always a gap in that area.
Yeah, absolutely. So as an actuary, what I expect is that self-insurers will, most self-insurers already get actuarial reports. What they don't always get now, at least in my experience, is they don't always get a breakdown of California only. So, for example, a lot of self-insurers are multi-state. And, I work with a lot of self-insurers that are multi-state, and I'll just do their total liabilities. Now I think there's an expectation that when you get your actuarial study, that it also includes a component that says this is the California-only portion. Because obviously the security fund, well, you don't want to give them your nationwide number because they're going to make you secure that or pay into the ASP based on that. You don't want to do that. So I think it would be to your advantage to ask your actuary to just do the California-only numbers, and then that is what would be reported to the self-insurance plans for calculating the security. As far as my personal plans or whatever, I mean, I think that it's fair to ask your actuary or ask me or whoever to decrease the liabilities or look hard at decreasing those liabilities a little bit for some of those provisions in SB 863, which will impact claims prior to January 2013. We're certainly saying that it'll impact claims after that, so why not, those before that? And I think that, it's going to be very important to educate your actuary on how you're implementing the reforms, because as I mentioned, it's how the regulations come out and how you implement these reforms is going to be a really big deal. And so you may need to educate your actuary on that, and also educate them on any ways that you're different than the statewide averages. Again, most actuaries are just going to look at the rating bureau numbers or some other statewide numbers and base their projections for you on that. If you can show that you're different because of your industry or wage or return to work or whatever, you should be prepared to make that case to your actuary.
A question from the web audience. Mark, do you think that the reform is going to cause a decrease in claim duration? And do you think there will be some sort of advantageous impact on loss development factors, both paid and incurred?
Yes. The short answer is yes. And I think that was one of the goals of the reform, is to decrease litigation, to decrease liens, both of which cause claims to be open for longer. And so by decreasing both of those factors, it should speed up both the payment and the incurred of your losses. So yes, it should speed it up. Any other questions?
You mentioned that the inflationary pressures would, on a net basis, cause increases somewhere from about 4%, I guess, to 10%. And I'm wondering if those inflationary pressures are related to the exceptions that weren't included in SB 863.
The exceptions that were included, you mean
Right,
like Alvarez Guzman?
Opioids and some of the things that were not addressed in.
Yeah, well, it's clearly due to those, but it's also due to all the things that were included. So it's, you know, it's also due to liens. It's also due to, you know, more litigation and so forth. So, but clearly some of the things that were not explicitly addressed, like Alvarez Guzman or like the opioids, have been drivers of the cost as well. All right, thank you very much.